All right, so let's begin. Today, women are progressively pursuing financial independence and breaking free from conventional gender roles and societal expectations, a shift which is also empowering them to achieve financial security and stability. Today on The Money Show, we are joined by someone who has helped thousands of women to build their businesses and achieve financial independence. Let's welcome on board Shweta Salve, co-founder, Swaven Village and Spud Salon, co-partner, Burger Factory, Mojim, Goa. Shweta, good evening and welcome to The Money Show. And wow, I mean, you wear a lot of hats. I was just looking at the kind of startups you have and setups you have got yourself involved in. So congratulations for that. Let me start with your journey. We really want to know, how did you become the Shweta Salve you are now?
Oh gosh. First of all, thank you for having me. It's a pleasure to be invited on this platform to speak about this because I think it's very important, especially as a woman. And the journey that I have started in my career to where I am today, it's a lot. And I think it's interesting to see where I have grown myself. And I would like to see women like me to grow ahead. So yeah, what has brought me Shweta Salve to where I am today? I just think a lot of drive, a lot of passion, and the forever want to keep kind of growing and building something interesting for myself.
So I can clearly see that you've made your mark as a successful woman entrepreneur. That's a very inspirational story. What all do you do actually? What are your projects like, and what have you got yourself involved in professionally?
You know, the question, what all I do actually is a lot. I think women in general kind of are used to wearing many hats, and we kind of have an innate quality to kind of juggle a lot of balls and kind of make sure that we don't drop any, from being a mother to a daughter, a sister, doing what I've been doing all my life and where I am today. So yeah, it's a lot to do, but it's very interesting to see this journey grow. Tell me your question again. I kind of am getting wrapped up in this. I would like to know exactly what specifically and how would you like me to start?
About your entrepreneurial journey, how did that begin? What was your inspiration, and why did you take that step?
So to be honest, I have been an actor. That is something which I have been known for. That's where my career started. I was an actor. I've always been in front of the screen. My journey, my career was pretty one-dimensional because that's what I knew when I was doing, which is great. I love what I did then as well, and I still do that. But my entrepreneurial journey kind of, to be honest, it kind of kick-started when I moved homes. Like I still have a home back in Bombay. I'm a Bombay girl, born and bred. But around the year 2015 is when I kind of took a little sabbatical from the industry. I wanted to kind of slow down. I wanted to kind of take some time out for myself. And I moved to Goa. And this is where I am. This is my home now, where in Goa. And spending time here is when I realized that, yeah, it's a lovely place. It's a great place to come for holidays and vacations. But now if I plan to live here, and I had just gotten pregnant. I was going to have a baby within a year. And I was like, if this is where I want to build my family and take it over, I need to do something more. And that's when things kind of started in place when it came to my entrepreneurial journey. For me, it's really been a roller coaster ride, let's be honest. But it's been one of the most rewarding experiences. You know, I've learned so much about myself. I've learned so much about business, which is something which I didn't think I had an aptitude towards. I must definitely give credit to a very supportive husband who kind of has been somebody who's always been in the business and he has that aptitude towards it. But he helped me realize that I have it too. And that's when I started my restaurant with my partner Mayank Dubey, Burger Factory, Mojim. And that's the first time I kind of learned the ropes of business and how to do this. And it wasn't anything that I've ever done before. I wanted to help and build a business where not only takes care of me, I also wanted to grow my journey. And hence Burger Factory. And then I started another company called Ritika & Co. with another partner of mine called Pia Trivedi, where we started a company called Ritika, but a brand called a Swaven Village, which is a homegrown pop-up market of fashion brands. And predominantly over 95% of the brands and the exhibitors that we showcase on this market are women led businesses. All of them are mostly homegrown businesses. And that's where things started. And very recently, now I am also dabbling into the beauty and skincare and hair, because that's something which I know that's where I come from the industry. And I'm starting it with another fellow female businesswoman who I'm starting a salon with her. So yeah, that's been my entrepreneurial journey so far.
Very inspiring, but I really want to understand the kind of roller coaster or the kind of struggles or maybe the challenges that you've gone through, in setting up all your a restaurant and then this women village that you just mentioned. It's very nice that you've also been incorporating and working with your female colleagues or female partners, but then it's not an easy world out there for a lot of women even now. There's a lot that needs to be done. You as a woman, and when you thought of getting into this entrepreneurship area, what were your challenges? What were the things that there was a lot, I'm sure, that you had to learn and unlearn as well, but then what were those tricky places or maybe those gray areas where maybe you were just trying to figure out things and then you just came up with so many flying colors?
Well, I think anything when you start for the first time has its own hiccups, has their own little speed breakers. Every journey that you take on is a learning experience. Nobody knows something immediately. So for me, this entrepreneurial journey has been different, like I said, because I came from a one-dimensional career, which was being in front of the camera, acting, being pretty, taking care, and showcasing that part of my talents. The fact that I realized that, okay, now this is where I want to go, the hiccups that maybe I would say is firstly trying to figure out if this is something that I really want to do and will I be good at it. Getting the right opportunities, and if they weren't there, making those opportunities for yourself. So I think that part was where the hurdle that I had to cross, where I didn't go out looking for them, because I felt that I don't want to come to a place where maybe I'll have to stop or maybe I'll have to take a break. I didn't want to get to that hurdle. I said, you know what, I'm going to create these opportunities for myself. Hence, and I'm very lucky, like I said, I have always, all my businesses are with partners who have had some kind, like especially in the restaurant, in Burger Factory, my partner had already opened a restaurant before, so he had the knowledge. I brought in my inputs, I brought in things that I know I could bring to the table. And then together we grew, and now the restaurant is Burger Factory Morjim, the one that I am involved in, is now about 7 to 8 years old. Village, the pop-up market that we started in 2019, Pia Trivedi and I. The hurdles there were probably, I would say, finding the right location, finding the right venue, getting people to understand that there are these two women coming from the entertainment business, models and actors. People don't try to take you all very seriously instantly, but I guess it's the way, the vision that you have, the passion that you have. And if you believe in yourself, really, and if you know where your vision is, and if you can portray that, I think there's nothing that cannot be achieved. So it takes a while. Every journey takes a while, but I guess if you know where you're going, and you take the right steps, it kind of smoothens out eventually.
Do you remember your first income from your modeling days and then your first income in your entrepreneurial journey?
My God, my modeling days, I think I was financially pretty independent very early. And that's thanks to the upbringing that my family gave me. They've always, kind of pushed me to do things that I was good at. So yeah, I've been pretty financially independent since very, very early. I think about 16 or 17 is when I started my career. I started with theater, I got into television, modeling, films, etc. So yeah, I remember that small little paycheck, but it meant the world to me at that time. And today, when I see what I have built and have grown and still growing, when I see those inputs, it's wonderful.
What was the
good
paycheck
reward.
like back when you were 16 or 17 years old?
I think if I'm not mistaken, probably it was for an ad film, and those back in the days we used to have model coordinators,
Right,
and those
yeah,
model
yeah.
coordinators used to take 10% or 15% of your
Okay,
paycheck,
okay.
and I think my was at the end of the day, I think I got my check was, I think, about 800 rupees for after paying my model coordinator, it's her commission.
And your first income or the profit that you earned from your first entrepreneur project, that was close to how much?
Ooh, those numbers, maybe I need to call up my accountant for that to let you know because he'll probably get a better answer for that.
Okay.
But it's interesting to see how the reaps, both careers are
Yeah,
amazing.
exactly.
They're still going well.
Yeah.
I have not given up in either of or. I'm like I said, I wear many hats. But it's nice to see when you reap those benefits, and it's interesting.
Okay,
And
so you sound like someone who had a very balanced and a very healthy rapport with money, right from your initial days, also because of the kind of upbringing you mentioned that you had. So now how do you look at money? How do you invest? Where do you invest? You also have a daughter. How do you teach money manners to your daughter?
To be honest, especially because you got my daughter and you've asked about her, what money lessons, let's say that way, what
Yeah.
money lessons I would like to give Arya, who's now 6 years old. But what I would like to kind of pass on towards her is that money is really just a tool at the end of the day. It can be used to achieve your goals, your dreams, but it's not really the end goal itself. I would like Arya to know that, never let money kind of control you. You need to have the power to control it. Another thing I would like to teach her is personal, to learn about personal finances. Like this is something which I learned earlier, is how to budget, how to understand, how to save, how to invest. The earlier you start teaching these, the better it is, as you grow in the longer run. I would like her to be financially independent. Like as I said, I started really early, and that's something I would like to pass it on to her. And it means not relying on others for your financial support. It's basically empowering to know that you can take care of yourself no matter what. That kind of financial independence is what I would like to pass on to my child. And another is investing in yourself. I think that's extremely important. Yes, we invest and we want to see our money grow, but most importantly, you need to invest in yourself. And this could mean like, I would like her to take courses. I would like her to attend workshops. I would like her to study. I would like her to study in the aptitudes or in the careers that she thinks that she's going to be good at and excel at, and start her own either businesses or whatever works for her, and make sure that investing in your own growth and development is equally important than investing financially and securing your future. And of course, I would like to say at the end of the day is to give back, which I think is extremely important. Use your money that you make to help others. There are many worthy causes out there that could use your support, and I think that's something that I would like. These are a few pointers that I would like to kind of pass on to Arya for sure.
To all the women entrepreneurs who are listening to you right now.
I'm sorry, I didn't get
One
that.
pro tip to all the women entrepreneurs who are listening to you right now.
Well, what I would love to tell them is that just do not doubt yourselves, is what I would say. There were times when I would kind of doubt myself and say, listen, am I better just in front of the camera? Am I just a pretty face? Am I just good as an actor? Am I a good dancer? And I know what I'm good at. Should I just stick to this? I would kind of sometimes doubt myself. Like this was probably to answer also one of their questions, and what were the hurdles? I think I also had a little bit of an internal hurdles, which I went through. So if I have to give a pro tip or a tip to other women entrepreneurs is don't doubt yourself. Um, Listen to your gut. I think your instinct and gut is something which will never go wrong and never give you a wrong advice. It's taken me 40 years to understand that, and that I wish I knew this earlier, but I guess you only learn things with experience in life. So I wish I'd always listened to my gut. So listen to your gut, listen to your instinct. Don't doubt yourself. If you believe in something, go for it. And there is nothing that you can't achieve as long as you know that you want this. And I think at the end of the day, if it's hard work, it's passion, it is what you can make of yourself at the end of the day. So don't doubt yourself ever.
All right, Shweta Salve, thank you so much for being on the show today, and thank you for being so inspirational and helping our women viewers, achieve no matter what they want to in their life. Thank you so much.
Absolutely. Thank you so much for having me, and all the best for everybody here.
Thank you. All right, we move on, and time to take a quick break, but then post that, let's talk about rebalancing your portfolio, and I'll be joined by Arun Kumar from Funds India after this break. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. Indian equity markets have run up Barclay, in recent times, benchmark indices have hit fresh highs, while the broader markets too have shown strong outperformance. Now, is it then the right time to book profits? And is this the right time to perhaps rebalance your portfolio? And where should you deploy additional funds? Let's understand all of this. I have Arun Kumar, Head of Research, fundsindia.com with me. Arun, good evening and welcome to the show.
Hi, Kal.
Time to rebalance, a strategy maybe that one should be adopting in their portfolio from time to time. But then right now, what kind of rebalancing and revamping in the portfolio are we talking about? Obviously, a lot depends on the kind of goals you have lined up with. But then if one is really heavy in some department of equity, do you think it's time to just maybe book profits and deploy that fund somewhere else?
Yeah, so the starting point is fairly simple that whenever there is an all-time high, there is a natural sense of unease for most of us because usually you hear the fact that you need to buy low, sell high. So the moment that you hear sell high, you kind of tend to associate with the all-time highs. And generally, there's this unease that there might be a market fall after this. And you add to the fact that the last 4 times, almost for 1.5 years, the Sensex has kind of got stuck in that 60,000 band. So every time it comes to the 60,000 levels, there's a 10-15% correction. So we had 4 times where it touched 60, 62, then again it fell. So the same again, most people were expecting probably for the same pattern to repeat, but again it's overshot that. So the first level of understanding would be that the all-time highs are nothing to be worried about, because if you technically think about it, most of us would say I would expect say around 10-12% from equity. So let's take 12%. In other words, you are saying that the Sensex or the Nifty should double every 6 years. So that's what 12% actually means in terms of the actual the absolute returns, right? So which means you're saying 60,000 should inevitably go to 1,20,000. Let's say at 12%, in other words, you're saying in 6 years it has to go to 1,20,000. In another 6 years, it has to go to 2,40,000. So which means net, it is impossible for the Sensex or the Nifty to grow without hitting all-time highs. So for any growing asset class, be it gold or real estate or equities, all-time highs are a given. So the second most important point is we also did a simple analysis of the last 23 years. We found that on average, if you only invested in all-time highs, your average 1-year returns were close to 14%. And 50% of the times you made more than 15% returns after all-time highs. So there is nothing to be really worried about an all-time high per se. And usually the way it works is that it gets stuck at all-time high levels for some point in time. Then it again breaks out, cutting a lot of all-time highs, and again the market. So this happened between 2008 to 2013. It was more or less stuck in the Sensex was stuck in the 20,000 levels. Then it shot up to 40,000 in 2018, and again it got stuck at 40,000 levels for probably 2-3 years. And then after that, it's now at 60,000. Probably the next level will be much higher. So overall, the breakouts happened, but we don't know whether this is a breakout or not. So
clearly there is no time to
yeah.
even time the profit taking part. Correct. Also, right? So how can one go about it then?
Yeah. So broadly, the idea would be that do not try to come out or get in based on the all-time highs. I think a simple idea would be that whatever is your asset allocation, say you are 70% equity or you might be 50, just make sure you give it a band of plus or minus 5%. So right now, because of the market moves, if you are say at 76 or 77, maybe you should bring it down to 70. But if you are say instead, due to the market rise, you're only at 74%, still not broken that 5% cutoff, you can continue with the existing allocation. So my sense is give it a 5% band, and as it is not exceeding your original allocation by 5%, you don't need to rebalance. If it exceeds, move some equity and then bring it back to debt. One is that. Other thing how you can do it is the incremental money, if you have your SIPs coming, put it more towards debt so that overall you bring the equity allocation back to the original. So these are two things that you can do.
So you are suggesting that one can increase the amount in debt by booking profit from their equity portfolio. But then what about reinvesting it? One should be doing it from debt itself now? So
again, the concept is fairly simple, that you look at what your current allocation is. So let's say you started with the intent that you have to maintain around 70% equity. Right now, if it is exceeding that by 5%, then alone rebalance it back. But if not, you can still continue with the original. You don't need to make any incremental changes. This is not the time to go either underweight on equity or overweight on equity. So in that sense, if at all your current allocation has probably moved up to 76 or maybe cut the 5% or more, that excess allocation of the 5 or 6%, you can move it into debt right now. And if you have incremental allocations, you can realign in such a way that majority of it goes to debt, so that overall it brings that 76% of equity slowly back to the 70%, but don't go below 70%. So don't go underweight, but just make sure that you are just rebalancing it back and building it close to that 70%. I'm saying for an example, it can be 50 or it can be 30, depending on what that current asset allocation split of that investor is.
So, Arun, are we also talking about within equity? Are we also applying the same rule maybe to book profit from mid cap, small caps?
Yeah, see, we are not in the camp that you will have to currently go underweight on mid caps or small caps. Generally, we've at a core portfolio level, we use the small caps for us internally. So we use small cap only as a tactical portion. So broadly, the way we kind of approach is that within equities, we look at it in terms of 5 different buckets. So the first bucket would be the growth at reasonable price style. And then the second style would be the value or contrarian style. The third would be the quality style. The fourth would be mid and small cap bucket. And the fifth would be the global bucket. So as long as you are 20% in each of these buckets, I think overall you have a good diversified portfolio. So if at all you are in excess in one of these styles, or you have too many funds, or you have an extreme overweight in, say, a particular AMC or a particular fund, then this is probably a good time where you can simplify your portfolio and kind of get it diversified across the 5 different styles. So I think this is a good time where you can simplify your equity portion.
And what about across asset class? I mean, equity, debt, we've spoken about, but then what if you have other asset classes also in your portfolio?
So broadly, the way we kind of look at it is that equity will be your asset class, which kind of gives you good returns over long periods of time. But again, comes with the volatility that 10-20% is a given every year, and a 30 to 60% is kind of to be expected every 7-10 years. So gold and debt is more stable. Gold is more like an anti-equity portfolio, where like generally when there is a crisis or equity doesn't do well, gold tends to do well. So overall, my sense is whatever is your starting allocation, say you are 70% equity and another 20% into debt and say 10% into gold, you can continue that same 5% band and make sure that all these 70 is within that 65 to 75. Similarly, debt is between 15 to 25. And again, gold is between, say, 5 to 15%. So if you maintain that, if there is any break, I mean, anywhere there is a deviation of more than 5%, you can either reduce or increase based on that. So I think overall, at different asset allocation, if you can keep this simple band, it should more than be enough at the current juncture.
All right, I think that will be all. Thank you so much, Arun Kumar, for being on the show and helping our viewers with their rebalancing strategy for the portfolio today. Thank you. We take a quick break, but then post that, let's talk about missing out the opportunities to participate in the market rally. Are you one of them who really feel the FOMO? We'll discuss all of this with Kaustubh Belapurkar after this break, and also get your mutual fund portfolio queries answered by him. Welcome back. You're watching The Money Show with me, Kavita Thaplayal. If you are someone who did not participate in the market rally and are now dealing with FOMO or fear of missing out, then worry not. On The Money Show, we have got your back. We will tell you how you can start investing in the current market and what should be your investment strategy and a lot more. So let's welcome on board Kaustubh Belapurkar, Director Fund Research, Morningstar Investment Advisor India. Kaustubh, good evening and welcome to the show. So can one really invest during these times of market high?
Hi, Kavita, and thanks for having me. And I think it's a very pertinent topic that you've raised, obviously, because we've seen the markets making new highs recently, and investors are wondering if they've been waiting on the sidelines what to do, right? And there's often that conundrum that do I wait? Do I wait for a correction? Do I invest all of it right now? So let me address that in two bits, and let me share some interesting insights that we ran through two studies, which will throw some light about just the way the market as an animal works in terms of returns, right? So the first one, essentially what it did was we looked at the past 10-year returns of the index. So take any broad index, the Nifty or the Sensex, and similar results would also follow for some of the other mid cap and small cap indices. But essentially what we did was we looked at the monthly series of returns for the index and compared that versus cash equivalent, which in this case was liquid fund returns, right? We put it in a sort of best to worst case scenario. So the best months on top and in a descending order of returns on a monthly time series. What the data showed us is that 11 months out of the 120 months over the last 10 years accounted for the entire outperformance of the market versus cash, right? So if you as an investor were not invested in the markets in those 11 good months, as we call them, you would have actually underperformed even just holding a liquid fund, right? So which is staggering. So 11% is even less than 10% of the time frame. And you can break it up into weeks or days. You will get similar sort of observations where a very limited amount of days or weeks or months account for the entire outperformance of the market versus something as something as simple as cash, right? So I think that's a very important lesson. Why? Because these time periods can come at any point of time, right? So you have to be invested in the market. What we call as time in the market is more important than timing the market. I think this is a very interesting case in point that shows that, right? So I think that's one very key takeaway for investors who are probably sitting on the sidelines wondering, has the market run up too much? Should I wait for it to fall? Here's a case study that, you can't really time the market. What's important is to stay invested in the market for a longer period of time, right? That's one. I think the other interesting study, and we talk about that equity is a great asset class, no doubt, but it comes with the baggage of volatility, short-term volatility. So how do we really make or ride the volatility, right? The right investing time horizon. So the other study that we did was we looked at the rolling returns of, again, the Nifty and the Sensex, over the last 20, 30 years. And essentially what we did is this was like a daily rolling, and we did it over different time frames. So let me just explain what that study told us. If you held as an investor, you came with only a 1 year investing horizon and you invested in these funds on the indices, on an average, you would have made maybe about 13.5% over the last 30 years on a 1 year rolling. But the range of returns was very broad, right? So on some lucky day, you could have made 100% plus returns, if you were entered on that one lucky day. But there were also times where the 1 year return was negative 55%, right? So the market fell, more than half your portfolio value was wiped out if you came only with a 1 year investing horizon. The market was actually negative over a 1 year horizon, right? So when we say that, you have to be in the long term, this is really one, example which tells you that very short-termism can actually hamper your portfolio. But as we extend this time horizon, so when we look at 3 years, we look at 5 years, extend that to 7 and 10 years, two things happen. One is the probability of negative returns, or the percentage of negative returns observed during this time period shrinks quite significantly. So
Okay, I think there's some technical issue with that, and we just lost Kaustubh there. But then to the time we get him back, very important things that Kaustubh also was trying to highlight is that timing in the market rather than time in the market should be the focus for an investor. I think I have Kaustubh back with me. Kaustubh, you want to continue?
Yes, Kavita, thanks so much, and apologies for that. So the point that I was making is that when you look at extending your time horizon, and the example that I was giving was if you're invested only with a 1 or 3 year time horizon, the number of observations that we noticed on the index, which were negative. So for 1 year, 1/3 of the time, had you only come with a 1 year horizon, you would have actually lost money, negative returns, right? But as you extend your time horizon, you go to 5 years, 7 years, 10 years, the probability of making returns and positive returns grows up significantly. The predictability of returns goes up, and that's what the historical data showed us. So the other tenet of staying invested with the right time horizon becomes very, very important for investors, and even more so in these times, right? When we are seeing new levels of the market, I think it's very, very important that investors come at the right time horizon. I think that's the first very important lesson, that always think about long-term with equities. Do not come with, looking at the past returns and expect the same returns over a very short time frame. I think that's the first thing. The second one, and I think, which was also being spoken about by the earlier panelists, was about asset allocation. I think that's very, very key. Every investor will have different requirements, different time horizons, and asset allocation should be followed at every point of time, not get too greedy or too conservative. I think, the right mix of asset classes is very, very important when you think about investing in the markets. Invest regularly. We all talk about SIPs, and I think I cannot stress more about, in times like this, do not, even if you have all the money available today, do not go all into the market, especially at these levels that we're seeing today. Stagger your investments over, at least the next 6-12 months. And obviously, if you have a, recurring SIP that's running over years, that's great, because I think investing regularly can really reap the benefits of, avoiding that market timing risk that comes in, in a volatile asset class such as equities. So I think if you keep these few simple things in mind as an investor, let's forget about where the market level's at. We don't know where it's going to be tomorrow, where it's going to be 6 months or 1 year down the line. No one can predict it. But you come with the right time horizon, 7-10 years,
Right. Right. So exactly. So rightly, as you were pointing out, that one needs to have realistic expectations. So we've lost Kaustubh again, but then once I get him back, we really would want to know as to Kaustubh. So the question that I was asking you was, so it's right that one needs to have a longer term strategy and one needs to invest continuously in a disciplined way so that you participate at all market movements and levels. But then right now, how should we be staggering our investment? Should it be via SIP route or even a lump sum if we try to do at different intervals? We will get the benefit of averaging in the longer term.
So I would definitely, even if you have all your money available today, I would still recommend staggering it, over the next maybe 6 to 12 months at least. And obviously, if you're running a recurring SIP, for longer years, that's great. But I would definitely not think about putting all the money at one shot right now. I mean, just given the vagaries of the market that we've seen, I would definitely recommend staggering it over the next 12 months, just to be, even in terms of peace of mind, because behaviorally investors tend to behave very differently. If you put all your money today and the market corrects, 15, 20% for whatever reason, they can behaviorally start pulling out money. So I think SIPs also kind of protect you against behavioral biases that, all of us are kind of susceptible to.
All right, so that was all about making the most of the market movement right now. And with that, Kaustubh, let's move on to our viewer queries also. I have Neeraj Verma on the phone line with me. Neeraj, good evening. How are you doing?
I'm doing fine, thank you.
From?
I'm from Assam, Neeraj Verma.
Okay. Neeraj, I think you want to start your investment strategies. I mean, in your mutual fund, you want to start investing by 5,000 per month for a period of 3 to 4 years. Is that it?
Yeah, that's right.
Okay. Any specific corpus that you want to accumulate in 3 to 4 years?
I mean, anyone can give me a suggestion. That's what I need.
Have you invested?
Because I have just sort of finished a 4-year investment which I have in cash, just been redeemed. So I just want to start a new one.
Okay.
I had Tata Global, which I have redeemed.
Okay. All right.
Which one will be useful? And I'm a senior citizen, just to inform you. So my time I've said 3 to 4 years.
3 to 4 years, and I believe the risk profile is also not very aggressive. And 3 to 4 years, any which ways, I don't think so. We can suggest you a very aggressive strategy over here. Kaustubh.
Right.
Kaustubh, what is your take?
Yeah, so I think, given the time horizon and, like I was alluding to in my earlier sort of response, that especially for volatile asset classes, you need a longer time horizon. And what I would suggest to Neeraj is, given that he has a 3-4 year time horizon, I would, I look to allocate a bulk of the money or the investment into, sort of fixed income funds, clearly with the mandate of not really losing capital, but getting a more steady sort of less volatile experience as a part of the portfolio. if he's amenable to taking on a little bit of volatility risk in his portfolio, perhaps up to about 15-20% in equities through index funds. Again, the reason why I'm harping on index funds, given that it's a limited 3-4 year horizon, you typically want to take it through large caps and not be susceptible to style drifts or kind of style cyclicality. So just buy an index fund. That'll just be the easiest way of doing it. And your fixed income allocation, which is about 80-85%. Typically, you would want to do it through some short duration funds, which would probably be an ideal way of, with no credit risk, getting into some of those strategies.
All right. Neeraj, do you want to ask anything else?
No, I was mainly interested in this. I'm an advisor in a tea factory, so I'm out at work. So this is what I was wanting to start a mutual fund because I've just redeemed one after 4.5 years.
All right.
And I gained well, so I want to, because I have investment in shares also.
Mm-hmm.
So I just wanted to 3 to 4 years. It could be 5 years also.
Okay. All right, Neeraj, thank you so much and all the best. We have to move on, and I have Avinash with me now. Avinash, hi. Okay, I think we just lost him, but then let's take up his question. Kaustubh, he wants to start an SIP of 50,000 per month with a time horizon of 20 years, and he wants you to suggest at least 10 mutual funds, and out of which in 5 to 6 he says that he'll be investing, and he also wants a foreign equity component in his investment portfolio.
So it's great that firstly that Avinash has this long time horizon of 20 years, and what I would recommend is obviously to start, especially if this is money that he doesn't envisage really touching upon for the next 20 years. We can largely go into an equity sort of portfolio for him, maybe keep 5% in ultra short liquids for emergency purposes, but I think the remaining can easily, given the time horizon, go into equity funds. What I would recommend is essentially building a mix between large, mid, and small, and I would think, given the extended time horizon, and if he's okay to take some risk, I don't know what his risk profile is, but we can add about 30-35% in mid and small caps, and the remaining into large caps, and this can be done through a mix of funds, right? So you can either do a mix of large, mid, and small, or you can add some flexi cap funds to achieve the desired allocation. And obviously, there's a whole host of funds that we like amongst all this space. So in the large cap, you have the ICICI Blue Chip, your Mirae Large Cap, the Birla Frontline, and if he wants to keep it simple, he can even just get into an index fund. Flexi cap, obviously, there's the HDFC Flexi Cap, the Parag Parikh Flexi Cap, the Kotak Flexi Cap, and similarly on the mid small cap side. The other thing that I think what's important for Avinash to think about, and like he rightly said, some global allocation. So one way is obviously, the Parag Parikh fund, and that's one of the reasons also, why it's different, is it also has an element of global allocation portfolio. So you can achieve, global allocation through this fund, or you can, potentially get into a NASDAQ sort of ETF, which will give you exposure to the largest sort of market, across the world. Also, what we're recommending through the funds that we've selected is give a good blend or a style diversification. Again, very, very important. I assume Avinash is probably investing for the first time. So it's important to think about style diversification where you're adding growth, blend and value style funds within the portfolio. And that's what we've tried to do by some of these funds that, kind of blend well together so that some portion of your portfolio is always working for you at different points of time. I think that's something that Avinash should keep in mind, when he's picking amongst these funds that we recommend.
All right, next question comes from Shilpa, and Shilpa has SBI Equity Hybrid Fund. She's in a lump sum investment out there, SBI Balance Advantage, SBI Equity Fund, Axis Small Cap, ICICI Prudential Technology, and the goal is 2 crores in 15 years. She has an SIP, a mix of SIP and lump sum in her portfolio.
Yeah. So I think, some very quick thoughts on what Shilpa really needs to do with the portfolio. Firstly, I see too much risk in the portfolio. I mean, despite the fact that obviously she's gotten a 15-year horizon, which is great. But two things, right? So one is when I just look at the SIP amounts of 5,000, 5,000, there's about 1/3 of that going to a small cap fund. I think that's quite risky. We want to bring that down to about 15% of the portfolio. Whatever said and done, large and mid caps should be your integral part of your portfolio. That's one change that you should definitely look to make. The second thing, and more importantly, she's got 1/3 of that going to a technology fund. Now, any sector, right, should only be a peripheral part of your portfolio if you can take a call on the sector. Right now it's about 33% of her portfolio. That is staggering. When you think about technology as a sector, and no views on the sector that I'm trying to give, but this is essentially what we've seen in the recent times, right? So post-COVID 2020, 2021, we had this huge run-up in tech stocks. We all know that. But most of the money that came into these funds was after the run-up. And that traditionally happens with human biases looking at past returns. But remember, sector rotation is, it is a rule of the market. It happens all the time. We've seen that, and we know, tech has kind of, relatively underperformed as compared to the other sectors since the last year and a half. And I think that's very important to keep in mind. So if you're overexposing yourself to a sector fund, keep that very, very limited, and ideally only investors who can take a call on the sector or want to express a very specific view on that sector should be taking some graded exposure. Definitely not 1/3 of your portfolio. So I would recommend Shilpa to stop SIP in that and look to invest in more diversified equity funds, and in a similar fashion that we spoke about to the earlier investor, between large, mid, and smalls. And she can truly enjoy the benefits of the underweight and overweight calls that a fund manager will take, but it'll be much more graded as compared to going 0 or 1 in a particular sector, right? That's one. With regards to her goal, she's got a goal of about 2 crores in 15 years. I think she'll have to be aggressive with her investments in terms of ramping up the investment. So not aggressive in terms of her approach necessarily, but in terms of currently she's doing about a 15,000 rupee SIP monthly. She'll need to aggressively step it up by almost 20% every year to make sure that she's got enough corpus built over those 15 years. And secondly, we spoke about the timing risk that comes in with entry, but there's also a timing risk that comes with exit. So you want to avoid that you have a goal 15 years down the line and you've come close to meeting it, but the market, invested fully in equity and it falls and your portfolio value falls well below your goal level. So you need to start thinking about not just planning how do you do asset allocation today, but how do you gradually move from equities to a less volatile asset class such as fixed income gradually over time as you start approaching your goal. Because if you plan that well, you can reach your goal comfortably, provided some of these measures that she takes, especially when it comes to reallocating the funds and stepping up the SIPs quite, smartly over the next, going ahead in the years.
I think with that, it's a wrap. Kaustav, thank you so much for being on the show and helping our viewers with their financial portfolio queries today.
My pleasure. Thank you.
And we move on in tonight's episode of IDFC First Bank Presents Leaders of Tomorrow. We inaugurate our Udaipur Springboard series as we delve into city's rich travel and tourism landscape. And in the first segment, Bhavesh Jatania, head startup banking. IDFC First Bank highlights the diverse variety of products that IDFC First Bank entails, and future elaborates how they act as a tool to foster the growth of startups. In the second segment, as part of our Wealth First special, Manish Gandharva, financial expert and wealth security planner, shares his insights on employing the right tools for wealth management and stresses on the need for using the appropriate methods of asset allocation.
Banks are large entities, right? The largest bank, private sector bank in India, post the merger is going to be some 30 lakh crores. 30 lakh crores. That's the number that we're talking about, right? And when banks become large, the units become large by itself. The banks live in islands, therefore, right? And that becomes a challenge for the startups who really grow quickly through their life stages. I told you startups become unicorns in 5 years. On an average, they survive, right? And therefore, island-based structure for the banks become an issue. While we have seen globally some of the banks addressing this issue, in India, I don't think any other bank has actually attempted doing that, barring us.
जो इतनी volatility चल रही है market में, right? इस माहौल में गोल्ड को या रियल एस्टेट को एक सेफ हेवन माना जाता है कि ये एसेट क्लासेस जो हैं ये तो सुरक्षित हैं ही. किस हद तक इस बात में सच्चाई झलकती है, या इज दिस ऑल old, outdated thinking and beliefs?
गोल्ड इन्वेस्टमेंट वैसे बहुत अच्छा इन्वेस्टमेंट है, मगर गोल्ड के अलावा भी और काफ़ी सारे इन्वेस्टमेंट ऑप्शन है, जैसे बॉन्ड्स हो गए, म्यूचुअल फंड हो गया, SIP हो गई, रियल एस्टेट हो गया। मैं ये कहना चाहूँगा कि इन्वेस्टमेंट कभी भी एक जगह नहीं करना चाहिए, इन्वेस्टमेंट को डाइवर्सिफाई करना चाहिए अलग अलग जगह।